Denzil Cooper had a 24-member internal audit department. Internal audit reported directly to CFO Sullivan for most purposes. She has two subordinates work as manager internal audit, Jim Mose and Glenn Smith. WorldCom's origins can be traced to the 1983 breakup with AT&T, and then it began operations in 1984. It became a public company through a merger with Advantage Companies in 1989. By the end of 1993, WorldCom was the fourth largest long-distance carriers in the U.S. WorldCom expanded its market rapidly during the 1990s.
And now we'll talk about the motivation to commit fraud by analyzing the fraud triangle. First, we'll talk about the pressures at WorldCom. Evers let it know that he wanted WorldCom to be the #1 stock on Wall Street, and this could be achieved through revenue growth. But in the industry, there was more competition coupled with less demand, and this led to increased pressure on the earnings to revenue ratio. In Q1 of 2000, it was at 42%, and it needed to stay there. But employees described this goal as wildly optimistic, pure fantasy, and even impossible. With the rationalization, Evers gave a speech to his senior staff about how they would all lose everything if their company performance didn't improve, and how much they needed to keep the earnings to revenue ratio at 42%. Even though this went against all accounting guidelines, the CFO Sullivan succumbed to the pressure, and he manipulated the accounting to be able to meet the 42% earnings to revenue ratio. There was the opportunity to commit this fraud because the board of directors, the audit committee, and the compensation committee all played too small of a role. They were simply uninvolved. Also, when there were company meetings, the format never changed, even when it should have, to talk about important changes in the company. Additionally, WorldCom made personal loans to Evers, and with the large company growing through acquisitions, everybody didn't know everyone, and so there were a lot of opportunities to commit fraud. Because the company was growing so quickly, everybody didn't know everyone that worked there. One of the articles that we read said, Evers created a culture in which the legal function was less influential and less welcome than in a healthy corporate environment. This led to kind of a negative corporate culture. It was an unhealthy environment. When there was a motion to create a corporate code of conduct, Evers actually called it a colossal waste of time and said that he didn't want it. It was very important at WorldCom to do as you're told by your superiors and respect those above you. And there's a suspicion that there were special financial rewards for loyal employees. The employees that did work there felt they didn't have any good outlet for voicing concerns, not like we have today with support for whistleblowers and hotlines for tips. They just didn't feel like they had a good outlet. And so this corporate culture was actually described by some as a psychic prison. Prior to the discovery of the WorldCom fraud, it was actually one of the leading companies. It was actually in the 42nd place on the Fortune 500 in 2001, growing strongly through acquisitions. WorldCom reached its stock price all-time high of $64.50 in 1999. In the years leading up to the discovery of the WorldCom fraud, we found that pre-tax income had been overstated by $7 billion. At the time, this was the largest overstatement in history. The misclassification of the $3.8 billion in payments increased net income by understating expenses. It also increased assets because capital costs are considered investments. This improved WorldCom's financial position before the fraud was discovered. The earnings to revenue ratio was manipulated so that 42% was reported instead of the 50% that it should actually have been. Of these 3.8 billion payments, more than 3 million of them were made in 2000, and 800 million were made in the first quarter of 2002. As you can see, in 2001 and early 2002, WorldCom would have reported an actual net loss, but instead reported $159 million in income, over $2 billion in income, and $240 million, respectively. What is prepaid capacity? It is the description on the accounting entries totaling $3.8 billion by WorldCom. There is no accounting support for these journal entries. There's no known definition for prepaid capacity. It seems to be related to the expense capitalization. The cost of the excess network capacity gave the company an opportunity to enter the market more quickly in the future, as long as demand increased. As we've said, this went against all of the accounting guidelines. Once the accounting fraud at WorldCom was discovered, their company's stock price fell dramatically, from its high of $64.50 in 1999 to less than $2 per share. Additionally, the company had a loss of reputation, and 20 million customers were hurt. Service was threatened on WorldCom's government contracts with Social Security recipients, the Federal Aviation Association, the Department of Defense, Congress, and the General Accounting Office. 17,000 jobs were lost, and employees were left with worthless retirement accounts. As you can see, the fraud had a terrible effect on the WorldCom stakeholders. Because so much of executive compensation is based on stock options, executives have a lot of motivation to make their earnings look as best as possible. In the case of WorldCom, this earnings management tipped over into fraudulent reporting because of the accrual releases and the expense capitalization. This went against all accounting guidelines, and there was no accounting support for it. And most importantly, with fraud, there was the intent to deceive, and we know this because of the large amounts that were involved.
Eventually, WorldCom had released so many accruals that the tactic was no longer able to achieve the much desired ER ratio, but revenues continued to decline, so they needed another solution, or scandal. This led Sullivan to come up with the bright idea of treating excess network capacity costs as capital expenditures rather than their proper classification as operating expenses. This decision resulted in the General Accounting Department capitalizing over $770 million of non-revenue generating line expenses into an asset account called Construction in Progress. At the quarterly report filing with the SEC on April 26, 2001, WorldCom was able to hit their greedily sought-after 42% ER ratio. It's hard to believe that between the hundreds of millions being improperly capitalized and the hundreds of millions of improper accrual releases, that it took so long for the deception of the managers to be detected. We believe that the main way these managers avoided detection for so long was through collusion. There was collusion everywhere. It seemed that just about everyone was in on it. Between the management, Evers and Sullivan, Evers had these crazy, unrealistic expectations, and he expected Sullivan to deliver. Sullivan knew that he was going to need more people, more than just himself, to deliver on those expectations. So he went to the controller, Myers, and used his role as his boss and some legitimate power to get him in on it. Myers was then able to go to Yates, the director of accounting, and get him involved, who was then able to approach Troy Normand, the accounting manager, and Betty Vinson, the accounting senior manager. They were both resistant at first, but for Betty, when faced with the choice of losing her job and being unable to provide for her family or commit fraud, she chose the latter. Betty and Troy subsequently released $828 million of accruals into the income statement and transferred $771 million of line costs into capital expenditures. While not direct, there was certainly indirect collusion going on between management of WorldCom and Arthur Andersen as well. What we're trying to say is that while Arthur Andersen was not directly approached and didn't directly consent to turn a blind eye or authorize inappropriate decisions by WorldCom, they might as well have. Arthur Andersen was more concerned about keeping their flagship and crown jewel of a client than the integrity of their work. And somewhere along the way, Arthur Andersen lost their independence. They began to assume that information recorded by general accounting was valid. They became very predictable in their auditing tests. They ignored red flags such as WorldCom refusing to provide certain accesses and documentation, WorldCom's stellar performance in a period when telecommunications was declining, and Arthur Andersen continued to treat WorldCom as a moderate risk client despite their risk software having rated them as a high risk for fraud, then subsequently upgrading that rating to a maximum risk. And the list goes on. Had there been systems of truly independent checks in place, this fraud may not have been able to go on for so long. But as it stood, the external auditors, Arthur Andersen, had ceased to be independent. The whole chain of command from general accounting all the way up to the CFO were not independent and were in fact colluding. And an internal audit was attempted to be kept in the dark and silenced by having Sullivan as the man that they reported to. Despite those restrictions, internal audit was able to break through and save the day. Suspicion arose from Cynthia Cooper, head of internal audit, in August 2001 when she was auditing corporate WorldCom and noticed $2.3 billion of capital expenditures, which was only $600,000 less than the WorldCom's operations and techs group, who was responsible for all of the telecommunications network. In March 2002, the head of the wireless business unit complained to Cynthia about how a $400 million accrual for expected future cash payments and bad debt expenses had been transferred to boost income. After approaching Andersen and being told that they don't have to answer to her, and being approached by Sullivan and told to stop her investigation, Cynthia secretly expanded her scope and became a financial audit of corporate WorldCom. Gene Morse, senior manager in internal audit, was Cynthia's partner in the audit and was the one that was able to get access to WorldCom's computerized journal entries. Once he had that access, he began working at night and secretly copied all incriminating data onto CD-ROMs as evidence. Then June 2002 rolled in, the June of justice. On June 17, 2002, Glenn Smith, manager within internal audit, and Cynthia Cooper approached Betty Vinson and asked her to explain several questionable capital expense accounting entries. Betty admitted that she had no support for those. Glenn and Cynthia then went to Gates, who denied all knowledge of those entries, and then Myers, who admitted there is no support for those entries. On June 20th, all of internal audit met with the audit committee, and not even Sullivan was able to provide a sufficient explanation for these entries. Shortly thereafter, on June 25th, WorldCom gave up and announced that profits had been inflated by $3.8 billion over the previous 5 quarters. June 26th, the SEC initiated a civil suit of fraud against WorldCom. Attorneys in the U.S. Justice Department launched criminal investigations into the actions of Bernie Ebbers, Scott Sullivan, David Myers, Buford Yates, Betty Vinson, and Troy Norman.
Mr. Sullivan intimidated Miss Coopers when she demanded further investigation on financial statements and warned her to stay away from the statements. The ethical issues faced by Miss Cooper are: should she let the fraud keep going and ruin her career, or should she start the investigation and report the fraud to the board of directors? The ethical obligations faced by Miss Cooper are: should she investigate the fraud, or should she listen to Mr. Sullivan and stop the investigation? The right way she should do is to conduct further actions to protect the organization's interests, stakeholders, and outside community, and the institutions of society. It is Ms. Cooper's obligation to protect financial statements users. She is obligated to them. Ms. Cooper had 2 choices: either let the fraud keep going, or conduct further investigation and report any frauds she found to the board of directors. If she ignored this fraud, employees and the stakeholders will lose more money, it will break her ethical obligation and ruin her career. It's a right decision to make to bring out to the board of directors, but she will never have she will have a hard time due to being a whistleblower. The reason Miss Cooper made the right decision is because she knew her ethical obligation and boundary of law. She was well-educated internal auditor. She had CPA license, certificate, information systems auditor, and certified fraud examiner. Betty Vincent caused and helped the wrong and failed to prevent it when she could and should have. She knew the methods used to boost the company's revenue were illegal, but still continued the acts as her free will. She could be considered as villain because as she morally responsible for the wrong and should be charged on the criminal fraud. Both of external auditors and board of directors are blameworthy. External auditors are required to provide reasonable assurance of detecting both material errors and fraud in the financial statements, but their lack of professional skepticism. External auditors rely strongly on WorldCom's internal audit control environment. Their lack of independence because of a business relationship. Besides, WorldCom had put restriction on external auditors to access information and yet did not report the matter to the audit committee. The board of directors, in the WorldCom lack of active participation during the board meetings, it's very hard and very inefficient to let board members to communicate outside the meetings. During the meetings, they were not able to challenge and question. They have little sense of company's culture. Bent Roberts Jr. was the chairman and he passed the power to the CEO, Ebbers. Ebbers indirectly has become a chairman of board of members. CEO duality occurs. It increases the risk of conflict of interest where the CEO or chairman will tend to focus on his own self-interest rather than the focus on shareholders' interest. There are two viewer lessons we need to know from the case. First lesson is whistleblowers. Even though Cooper did the right thing, the experience wasn't exactly gratifying. A lot of people applaud her action, but many co-workers shunned her. Some even blamed her for the company's troubles. She's never been thanked by any senior executive at WorldCom. Whistleblowing often means career suicide. A survey of 200 whistleblowers conducted by the National Whistleblower Center found that half of them had been fired for blowing the whistle. So it is very hard to get to know the frauds happening in the company. Second lesson is the fraud never pays. With the former WorldCom CEO, Ebbers served a 25 jail sentence for fraud and conspiracy as a result of the company's fraudulent accounting and financial reporting. The lesson here is that fraud never pays.